Welcome back to TV5 News at 9. It's time now for Aging in Style with American Retirement Advisors. Joining us is President and owner Joe Vitale. And Joe, always good to see you calling in. How are you?
Doing good. Good morning. Good morning, Blake. How you doing?
Doing great. Thank you. Yeah. Don't forget to get Joe's newsletter, Financial Vitals, for all the latest in market trends and financial news. There's the QR code on your screen right now so you can get access. But we're going to go today's topic, financial burnout. Are you worried about your retirement? And we just want to talk about ways to get secure. So, Joe, tell us what's driving the decline in confidence of workplace savers when it comes to being on track to retire with the lifestyle, of course, that we really want in our life.
You know, you see a lot. Everybody, in the past, everybody was looking for the best rate of return, and it was almost, everybody's trying to. You see the market's going up, and everybody jumps in, but then it goes down. They pull out. They're afraid to get back in, out, in, out. They don't know what, and a lot of times, everybody's, if they stay, you hear this all the time: stay the course, stay the course, stay the course. And it was like, I can't stay the course. I don't know. I'll never make it back. And there's a lot of stuff to be concerned about with the market right now. The market has been doing good for this year. Everybody was talking about a recession. And could we still have it? Absolutely. But they're saying that, we had it last year already because we had the pullback in the market. So the burnout is real because the ups and downs, the high and lows, the ebbs and flows. And it gets to a point where you can't, a lot of people are saying, Joe, I just don't know what to do anymore. How do I find that good rate of return? How do I make this money last in retirement? And the majority of people, if they keep saving like they've been doing in their 401ks and they're getting their matches, and all I can tell you is we always encourage everybody, especially if they're getting a match at work, my gosh, maximize that as much as possible, but also make sure you're doing Roths. Make sure you're doing as much tax-free money as you can in retirement, because taxes are going to be going up. It's inevitable with all the spending, with everything going on, with the deficit, we're going to see taxes go up. So we have to make sure we have a plan and that we've got tax-free buckets, but we're good savers. So that's where we come in, and a lot of times the burnout is we say, let me alleviate some of this burnout from you and let this go. Because if you're striving for retirement, making sure you've got enough money, make sure you get out of debt, because if you don't get out of debt and have all these things in retirement, the burnout's even more real at that point. So it's nice to have that peace of mind where you can just let go and say, hey, you know what, Joe, take it from here, or, help me with all this. And it's nice to have something where you can have that peace of mind, not worry about it. Find safe rates of return, find ways to have growth, but just have a plan. And if you don't have a plan, that's where the burnout really gets real.
Yeah, and so you would say, having that matching in the 401k and whatnot are good strategies to, build up your funds in the meantime?
Absolutely. The matching with the 401k is huge, and some people don't have a match, and we'll look at other avenues, and if they have a Roth within it, so you can maximize your contributions to your 401k, your Roth. If you're not incomed out, there's other ways to also put into a Roth. There's other strategies. There's life insurance, retirement programs. There's all different types of strategies to diversify. And even if, I've had families where even if they just do nothing but maximize their 401k for 30, 40 years, you're retiring a millionaire. And that's the dream, right? Oh my gosh, I'm a millionaire now. I can live the good life. But the fear is still, well, I'm only 60 years old. How long is this going to last?
Right.
So that's where the next phase comes in. How to make the money last. So you have to have a plan. You have to have a strategy. Yes, maximize that 401k as much as possible. But another thing too is, depending on the income, where a lot of depending on if you're under $100,000 a year, as an example, as an income. You're under right now in a 12% tax bracket. So even though you're maximizing that 401k and that match, you're in a low tax bracket. Let's make sure that if there is discretionary money, let's put that into some Roths to get some tax-free money, because we're in a very low tax bracket, and to save money at 12% when it can be growing tax-free, that's another good strategy. So we want to look at the whole thing as a whole and get that plan together.
What can we do to really ensure that our retirement funds are not affected as badly, with a volatile market?
Diversify. You have to be diversified. Everybody says, well, the bond portfolio, that's 60-40. When you go into your 401ks, you've got that 20-40 retirement program, and there's a good mix of bonds and stocks. And that's always been pretty good for the most part, with the exception of last year when we had the perfect storm. Interest rates went up, bond values went down. And everybody who was in that that strategy saw a big decline in bonds, and it's like, well, wait a minute, that's supposed to be my safe haven. I got to make that up now.
Yeah.
Bonds are coming back up, but still the interest rates went up, bond values went down again. So you're going to have bonds are coming back, but you need to make sure that you've got other strategies. You've got a safe bucket of money that's not going to be affected by the market. Whether it's in a 3.5% money market, or whether it's in something like a fixed index annuity, or a fixed annuity that can have a guaranteed rate of return with no risk. You need to have a little bit of money that's safe and protected that you could always get to if the market goes down and you need to grab it. So it's all about diversification and having a bunch of buckets. Your tax-free bucket, your taxable bucket, your gross bucket, your emergency fund bucket. You have to have everything in order.
And, we've been talking, of course, a lot about inflation. Can we really avoid any effects of inflation, Joe?
Well, inflation is transitory. It's been 3 years, but it was at 9%. We're down to about 3.25 or such. So we're seeing inflation come down, but that's wage inflation really hasn't come down. We're starting to see some things come down. But when you look at, let's be honest about the inflation. Even though they're saying we're at 3% inflation, try to go to McDonald's for under $10, right? Which is ridiculous right now.
Yeah.
But you're seeing a lot of food. You go buy anything, any food, everything is a lot higher than it was a couple years ago. And we were just doing the math on that the other day. It's like, my gosh, it's just crazy. So yeah, you are finding good rates of return. You can get a guaranteed 5% rate of return out there, which is not what it used to be, right? The best rate of return was probably 2 to 3% that you could find. So now we're seeing a 5% rate of return. So that is keeping up with inflation right now because we're at 3%. But long term, you have to, if you've got proper diversification, you've got that guaranteed bucket, and you can get 3 to 5% on that. That's going to help. Then have money poised for growth, because a good stock portfolio is going to outpace inflation. But you can only do that if you have a safe bucket of money to pull from.
Yeah. All right, Joe. So we also want to hear from you on lessons learned about recessions and kind of how we can apply that now to our retirement.
Yeah, and that's the biggest fear is, there's a lot going on right now. With the push for digital currency, with the American debt. You look at right now, we've been downgraded, right? And that was a big thing, is they went from AAA rated to AA++, and that was the U.S. debt. That's not something that we want to see. We want our dollar to be strong. So the recession fear is still kind of out there. There's a lot of turmoil in the market right now. And even though the earnings are really good, the market is resilient, and the companies are still growing, and the job market is still good, the recession fear. So I don't want to live in fear. That's the biggest thing. A lot of people doom and gloom, or it will never happen, right? Why not just be protected regardless? Why not have your safe bucket of money? Why not have your growth money? Why not have properly allocated, which we talk about all the time, so that if we do have a deeper recession, or we do have it where it's not a soft landing, you still are protected. You've got money safe that you can pull from. And if we're wrong and we're not having that recession, the market keeps going like crazy, we've got money growing in the strategy so that we can capitalize from it as well. Again, proper allocation, making sure that regardless of come up and down, you've got everything in the right order.
It sounds like preparedness is good and last minute decisions pretty bad.
Yeah, that's right. No knee-jerk reactions. We want to be prepared regardless.
That's for sure. Joe, how do we make sure to have enough to retire when the time is right? Is it through, some of these suggestions or strategies like diversification?
Yeah, you see a lot of that with the diversification is if you have the ability to, especially 2 to 3, 4 years out, we're looking at, a lot of people still love that pension, but very few people have the pension anymore.
Yeah.
And to have that mailbox money, or that money coming in every month like clockwork, that's something that gives a lot of people a lot of peace of mind. So you can prepare for that. You can say, hey, I'm 3 years out, or I'm 2, 3 years out, or I'll need this money. Some people like to replicate a pension with a fixed index annuity or an income annuity. That's great for a sliver of it. You don't want to put all your eggs in that basket, okay? Because you also want growth. However, those people who don't want any risk, that's a great solution. But to have that income, that's a great way to generate income through that. So you can prepare to let that money grow and grow and grow. That's a great way. Another way we talk about, we're looking at some dividend stocks, looking at ways to kind of shift as we need the income to give income regardless of market volatility, where we've got that reoccurring income stream, so important for peace of mind in retirement.
Joe, always a pleasure talking to you about this. Thank you for coming on.
My pleasure, Blake. Good to see you again.
Good to see you too. And don't forget, before we go, to get market updates and so much more through Joe's newsletter, Financial Vitals. And also, for more information on this topic today, head over to the Aging in Style page on WNEM.com.